Welcome to the Deep Dive, the place where we try to cut through some of the confusion around financial reporting and hopefully build you a more direct, actionable roadmap.
That's the plan.
Today, we're tackling, well, arguably one of the most crucial and definitely high-scoring standards in the ACCA Financial Reporting syllabus, IFRS 9 financial instruments.
It certainly comes up a lot, and it can feel quite daunting at first glance.
Absolutely. If you're an FRS student, you'll know IFRS 9 replaced the, let's say, notoriously complex IS-39 framework. The aim was simplicity, right?
Supposedly, yes. Simpler in structure, perhaps.
But true simplification doesn't always mean it becomes easy. It often means finding the core logic, the thinking behind the rule.
Exactly. And for IFRS 9, that logic really centers on how you classify financial assets. Get that right, and the rest starts to fall into place.
So that's what we're going to try and dissect today over the next, say, 30 to 40 minutes.
Sounds good.
Our mission isn't just to, list the rules. It's to give you, the listener, a really comprehensive understanding. So you can look at an IFRS 9 exam question and hopefully see the path to the answer.
Moving beyond just memorizing things.
Precisely. Straight into applying the concepts. Okay, let's start unpacking this. Where do we begin? The absolute basics.
Yeah, let's set the stage. We're focusing purely on the principles of IFRS 9 today, aiming for that logic to stick. And step one is always defining the instrument itself.
Right. What is a financial instrument?
At its heart, it's simple. It's any contract that creates a financial asset for one entity, let's call them Company A, and at the same time creates either a financial liability or an equity instrument for another entity, Company B.
Okay, so it's always a two-sided thing, a contract linking two parties.
Always. Instruments exist in pairs, connecting two balance sheets. Think about some basic examples. If Company A buys shares in Company B...
A gets an asset, the investment.
Right, and B has issued equity, the contract links them. Or if A buys B's debt, like a bond...
A holds the asset, the bond. B owes the money, so B has a liability.
Exactly. And it even applies to really routine stuff like selling goods on credit.
Oh, right, like a normal trade receivable.
Yes. The seller gets a trade receivable. That's their financial asset. It's a contractual right to get cash later.
And the buyer, they have a trade payable, their obligation to pay the cash. So that's the liability side.
Precisely. Understanding that interconnected nature, that every instrument has two sides, is really the essential starting point before you even think about how to classify it.
Got it. Okay, so that's the foundation laid. Now, let's dive into the bit that often causes the headaches. Classifying financial assets.
Yeah, this is critical.
Because, as you said, classification is like the engine room for IFRS 9, if you get the classification wrong.
Everything that follows measurement, calculations, impairment, it'll all be incorrect.
The stakes are pretty high then, especially in an exam.
Absolutely. Now, IFRS 9 does streamline classification for financial assets into three main measurement categories. But, and this is crucial, it forces debt instruments, things like loans, debentures, bonds, through a pretty rigorous two-step assessment first.
Two steps, okay. And this is different from the old IS-39.
Very different. IS-39 had more categories and allowed more management judgment, which led to complexity and maybe inconsistency. IFRS 9 pushes for a more objective analysis based on these two tests.
And the outcome of these tests tells you.
It determines whether that debt asset can use the simplest measurement method, which is amortized cost, or if it has to be measured at fair value.
Right. And you mentioned it gets interesting here.
Yeah, because the model forces you to look at two things. The company's own intention, their business model for managing the asset, and the actual design, the characteristics of the instrument itself.
Okay, let's break that down. Test one first, the business model test. You said this is about the company's intent.
Yes, this is the inward-looking test. It asks a fundamental strategic question. How does the entity actually plan to manage this specific group of assets? What's the objective here?
And IFRS 9 specifies certain models.
It identifies two main business models that allow you to potentially classify the debt away from the default category, which is fair value through profit or loss, or FVTPL.
Okay, what's the first model?
The first and the simplest is what we call the hold-to-collect model.
Hold to collect. Makes sense.
Yeah, the name says it all. The entity's objective is purely to hold this debt asset right through to its maturity date, just collecting all the scheduled contractual cash flows, basically, the principal repayments and the interest payments along the way.
So they're not planning to sell it. They just want the cash it generates over its life.
Exactly. The management focus is on realizing those cash flows internally, not on trading the asset for gains in the market. If that's the objective, it meets this first criterion, potentially leading towards amortized cost accounting.
Okay, that's the hold to collect model. What's the other one?
The second relevant model is the collect and sell model.
So a bit of both.
Precisely. It's a mixed approach. The business objective here is both to collect those contractual cash payments and potentially to sell the financial asset before it matures.
Can you give an example of when that might apply?
Think about maybe a bank's portfolio of loans or bonds. They collect the regular interest payments, absolutely, but they also actively manage that portfolio. They might sell instruments if market interest rates shift favorably, or maybe if the credit risk changes, or just to manage liquidity needs.
Okay, so they're holding for the cash flows, but also keeping the option open to sell, if it makes sense.
That's the one. This mixed objective collect and sell is the requirement needed if you want to classify the debt instrument under the fair value through other comprehensive income category, or FVOCI for debt.
Right, FVOCI debt. So hold to collect points towards amortized cost. Collect and sell points towards FVOCI debt. So what happens if the company's intention doesn't fit neatly into either of those? Maybe they plan to trade actively, flipping the assets quickly, or manage the portfolio based purely on fair value changes.
Well, if their intent falls outside those two specific models, if they're primarily trading or managing based on fair value fluctuations, or maybe just planning to realize cash flows mainly through sales rather than holding made, then they immediately fail this business model test.
And the consequence of failing test 1.
The consequence is significant. The asset must be classified as FVTPL, fair value through profit or loss.
Regardless of what the asset itself looks like.
Regardless, if the business model isn't hold to collect or collect and sell, it defaults to FVTPL. The logic is that the entity is effectively managing the asset based on its fair value changes, so measuring it at fair value with changes in P&L is the most relevant way to show performance.
Okay, that makes sense. But passing this test isn't the end of the story, right? You said it was a two-step assessment.
Exactly. Passing the business model test is just the first hurdle. If you pass, meaning your model is either hold to collect or collect and sell you, then must proceed immediately to test 2. This test looks at the instrument itself.
Test 2, the contractual cash flow test. I think I've heard this called the SPPI test.
That's the one. SPPI stands for solely payments of principal and interest.
Solely payments of principal and interest. Okay.
And unlike test 1, which looked inward at the company's strategy, test 2 looks outward. It examines the actual contractual terms, the inherent design of the financial asset itself.
Right, so we need to be clear on what principal and interest actually mean here. I suspect interest might be broader than just, say, the stated coupon rate on a bond.
That's a really critical distinction, especially for students. You're absolutely right. Principal is essentially the fair value of the asset when you first recognize it. Think of it as the amount the lender, the investor, originally put in that hasn't been repaid yet.
Okay, the amount outstanding.
Yes. And interest, in the context of SPPI, is defined quite specifically. It's compensation for several things bundled together.
Such as?
Well, obviously, the time value of money. That's the basic return for lending money over time. Then there's compensation for the credit risk associated with the principal amount outstanding, the risk the borrower might not pay you back.
Makes sense. What else?
It also includes compensation for other basic lending risks like liquidity risk and potentially the costs involved in actually holding or servicing the asset over its life. And maybe a profit margin for the lender, too.
So it's quite a bundle of factors that make up interest for this test. Time value, credit risk, other lending risks, costs.
Correct. The core logic of the SPPI test is this. Do the contractual terms of this debt instrument mean that the cash flows you will receive over its life consist only of repayments of that principal amount and payments that represent interest, as we've just defined it?
So it needs to behave like a straightforward, standard loan or bond.
Essentially, yes. Do the cash flows look like what you'd expect from basic lending? For the asset to qualify for either amortized cost or FVOCI debt classification, the answer must be yes. Those cash flows must solely be payments of principal and interest.
And if they contain anything else, some other element.
If the cash flows include any element that could be considered compensation for something other than those basic P&I components, or, importantly, if the principal value itself could change based on factors unrelated to basic lending, then it fails the SPPI test.
Okay, can you give an example of something that would fail? What kind of features are we talking about?
This is where it gets interesting. The SPPI test effectively filters out instruments that have complex features, maybe embedded derivatives or unusual kicker clauses. For instance, imagine a bond where the interest payments aren't fixed or linked to a standard benchmark rate, but are instead contractually tied to, say, the price of gold.
Ah, okay, so the interest payment goes up if gold prices go up.
Exactly. That linkage to a commodity price means the cash flow isn't solely interest reflecting time value and credit risk anymore. It's got this other element mixed in, so it would fail the SPPI test.
What about other complex features?
Things like instruments with leverage features where the return is magnified based on some index, or maybe an instrument where the issuer has an option to repay the principal at an amount significantly different from the original amount based on some future event unrelated to credit risk, like a stock market index hitting a certain level. These would likely fail SPPI too.
So this SPPI test feels like a really crucial filter. It ensures that anything with these sort of complicated, maybe derivative-like features, anything that distorts that basic lender-borrower relationship.
It's pushed into fair value accounting.
Right. It prevents companies from hiding potential volatility from these complex features within the smoother amortized cost or FVOCI accounting methods.
That's the key insight, absolutely. If the instrument's terms are complex, if the cash flows are driven by factors beyond basic lending, IFRS 9 essentially says, okay, this isn't a simple loan. You need to measure it at fair value through P&L. That's the FVTPL classification acting as a failsafe.
But if it is a simple instrument, a standard loan or bond, and it passes this SPPI test.
And it also passed the business model test.
Right, both tests pass.
Then you can confidently move on to part 2, which is figuring out the specific measurement category. Amortized cost, or FVOCI debt, based on which business model test it passed.
Excellent. That clarifies the classification logic really well. So, passing the tests leads us to measurement. Let's connect those test results now to the actual accounting outcomes. What do these categories actually mean in practice for measurement?
Okay, let's start with the one that often requires the most calculation work for students, Category A amortized cost.
Right, the one linked to the hold-to-collect business model and passing SPPI.
Precisely. This category is restricted. It's only for debt instruments that pass both those tests. The business model must be hold to collect, and the cash flows must be SPPI compliant. Think of it as the standard treatment for simple, long-term lending, where the plan is just to hold it and collect the payments.
Okay, walk us through the measurement then. How is it recognized initially and what happens after that? This is where the effective interest rate comes in, isn't it?
Correct. Initial measurement is at fair value, which is usually the price paid. But, importantly, you include any directly attributable transaction costs in that initial value.
Ah, okay, so broker fees, commissions, that sort of thing. Yeah. They get added to the assets cost.
Yes, they become part of the initial carrying amount. This is the key difference compared to FVTPL, so it's a potential exam trap right there.
Got it. Include transaction costs for amortized cost. What about subsequent measurement?
Subsequently, you use the amortized cost method. And the engine driving this method is the effective interest rate, or EIR.
The EIR. This isn't always the same as the coupon rate, is it?
Often it's not, especially if the instrument was bought at a discount or premium, or if there were transaction costs. The EIR is the specific interest rate that would exactly discount all the expected future contractual cash flows, both the interest payments and the final principal repayment back to the initial net carrying amount, the fair value plus those transaction costs.
Okay, so it's calculated to reflect the true economic yield over the life of the instrument.
That's the perfect way to put it. The effective interest method ensures that the true economic interest income is recognized smoothly in the profit or loss statement over the instrument's entire life, even if the actual cash received each period, the coupon payment, is different. It matches the economic reality of the return.
Right. Let's make this concrete. Can we use the source material example? The one where Norman buys debentures at a discount, but they're redeemed at a premium. That seems like a classic case where EIR would differ from the coupon.
Absolutely. That's a perfect illustration. So Norman bought 10,000 debentures. They have a face value, a par value of $100 each, but he bought them at a 2% discount.
So he paid $98 each.
Right. $980,000 in total. $10,098. Now, these debentures are redeemable in 4 years, but not at par. They redeem at a 5% premium.
So redemption will be at $105 each. or $1,050,000 in total.
Exactly. He pays 980Ks now, gets 1,050K back in 4 years, plus interest along the way. The stated coupon rate is 4% per year on the par value, but because of the discount purchase and the premium redemption, the calculated effective interest rate EIR is higher, given as 5.73%.
Okay, 4% coupon, 5.73% EIR. Let's walk through the accounting. Step 1, initial recognition.
Initial recognition. Norman pays $980,000. Let's assume, just to keep it simple for now, that there were no transaction costs. So the initial carrying value of the financial asset on his balance sheet is $980,000.
Okay, now what happens at the end of year 1? Subsequent accounting.
Right. At the end of year 1, Norman needs to recognize interest income and his profit or loss. And critically, this is calculated using the EIR, not the coupon rate.
So income is $980,000 times 5.73%.
Exactly, which comes out as $56,154. That's the income hitting the P&L.
But wait, the cash he actually receives is based on the coupon rate, right? 4% of the par value.
Correct. The cash received is only 4% of the $1 million par value, $10,100. So he only gets $40,000 in cash.
And this is where the amortized cost mechanism really kicks in. He's recognized income of $56,154, but only received $40,000 cash. What happens to that difference of $16,154?
That difference, the $16,154, is essentially interest income that has been earned economically but hasn't been received in cash yet. Under the amortized cost method, this amount is added to the carrying value of the asset on the balance sheet.
So the asset value increases.
Yes. The new carrying value at the end of year 1 becomes $996,154. That's the original $980,000 plus the $16,154 difference.
And this process continues each year?
It continues each year. You calculate the interest income based on the new carrying amount using the EIR, compare it to the cash received, and adjust the carrying amount by the difference. You see this systematic increase in the asset's carrying value over the 4 years.
Why is it increasing? Oh, because it started below the redemption value and needs to end up higher.
Precisely. It started at $980 discount purchase and needs to reach $1,050 premium redemption by the end of year 4. The effective interest method mathematically guarantees that this unwinding of the discount and accretion of the premium happens smoothly over the life, so the carrying value hits exactly $1,050,000 at maturity. It forces the recognition of the true yield period by period.
That's a really clear walkthrough, thank you. That EIR calculation and the adjustment to carrying value is fundamental for amortized costs. Okay, let's switch gears to the category that often seems simpler but can hit the P&L harder. Category B, fair value through profit or loss, FVTPL.
Okay, right, FVTPL. This is essentially the default category.
What falls in here automatically?
Well, 2 main groups. Firstly, any financial asset that simply fails the dual classification test we discussed earlier. So any debt instrument that fails either the business model test or the SPPI test.
Like that bond linked to gold prices we mentioned.
Exactly. That would land here regardless of the business model because it fails SPPI. Secondly, FVTPL is the default for all equity investments in shares, unless the entity makes a specific irrevocable election to use FVOCI instead.
Okay, so most shares end up here, unless there's a deliberate choice otherwise.
Yeah.
Now, how does the measurement work for FVTPL? You mentioned a key difference with transaction costs.
Yes, that's a crucial difference. Initial measurement is, again, at fair value of the price paid. But for FVTPL assets, any transaction costs are excluded from the asset's initial value.
Excluded, so where do they go?
They are recognized immediately as an expense in the profit or loss for the period.
Why the different treatment compared to amortized cost?
The thinking is that if an asset is classified as FVTPL, it's often because it's held for trading, or its performance is being evaluated based on fair value changes anyway. So the transaction costs are seen more as a cost of trading, like an operating expense, rather than part of the asset's fundamental cost. They hit the P&L straight away.
Yeah. Okay, FVTPL, expense transaction costs immediately. What about subsequent measurement?
Subsequent measurement is pure mark-to-market, as people often call it. The asset is remeasured to its fair value at every single reporting date.
And the gains or losses from that remeasurement?
They flow directly into the profit or loss statement for the period, all of them. Unrealized gains, unrealized losses, they hit the P&L immediately.
So this creates potentially high volatility in the reported profit figure, doesn't it?
Absolutely. If the market value of the asset swings up or down, that swing is reflected directly in the bottom line profit. Immediate visible volatility.
Let's use the Norman shares example from the source material to illustrate this. He bought some listed shares.
Right. Norman buys 100,000 listed shares at $5 per share. That's $500,000. He also pays a broker commission of $0.25 per share.
Okay, so $25,000 in commission. $100,000.25 in dollars.
How is this recorded initially under FVTPL?
The initial recognition of the financial asset, the shares on the balance sheet, is just the fair value, $500,000.
And the $25,000 commission. That $25,000 commission is expensed immediately to the P&L in the period he buys the shares.
Got it. Asset $500, P&L expense $25K. Now, what if the share price falls by the year end, say to $3.50 per share?
Okay, at the reporting date, Norman must remeasure the shares to their current fair value. 100,000 shares at $3.50 is $350,000.
The carrying value was $500,000, so that's a drop of $150,000.
Correct. And under FVTPL, that entire $150,000 unrealized loss is recognized directly in the profit or loss for the year.
Ouch, that's a big hit to profit. Shows the volatility clearly.
Exactly. That's FVTPL in action.
Okay, that covers amortized cost and FVTPL. Now for the third category, the sort of hybrid one. Category C, fair value through other comprehensive income, FVOCI. This one seems to cause confusion, partly because the rules differ for equity and debt instruments classified here.
That's right. It operates differently depending on whether it's an equity investment or a debt instrument. Let's start with equity investments under FVOCI.
Okay. When can you use FVOCI for shares? I thought FVTPL was the default.
It is the default. But IFRS 9 provides an option for equity investments. An entity can make an irrevocable election on an instrument-by-instrument basis at initial recognition to measure an equity investment at FVOCI.
Irrevocable, meaning you can't change your mind later.
Correct. Once you choose FVOCI for a specific equity investment, you're stuck with it until you sell the asset.
And why would a company choose this? What's the condition?
The condition, or perhaps the rationale, is usually if the equity investment is not held for trading. The standard doesn't explicitly require a reason, but typically it's used for investments held for strategic purposes, maybe long-term holdings in other companies, where the primary goal isn't short-term profit from price changes.
Okay, so a strategic intent to hold might lead to electing FVOCI for equity. What about debt instruments under FVOCI? When does that apply?
FVOCI for debt is not an election. It's determined by the classification tests we discussed earlier. It applies if the debt instrument passes the SPPI test, meaning simple P&I cash flows, and the entity's business model is the hybrid collect and sell approach.
Right, the model where they aim to collect cash flows but also might sell the asset.
Yeah.
Okay. So different paths to get into FVOCI depending on equity versus debt. How about the initial measurement? Is that consistent?
Yes. Thankfully, initial measurement is consistent for both FVOCI debt and FVOCI equity, and it mirrors the rule for amortized cost.
Which means?
Fair value plus directly attributable transaction costs. So again, commissions and fees are included in the initial carrying amount of the asset, unlike FVTPL.
Okay, include transaction costs. Got it. Now, the really different part must be the subsequent measurement. How do changes in fair value get treated?
This is where the other comprehensive income part of the name comes in. Subsequently, the asset, whether debt or equity, is remeasured to its fair value at each reporting date.
Just like FVTPL.
Yes, the remeasurement to fair value is the same. But, and this is the crucial difference, the resulting gains or losses are not recognized in profit or loss.
Where do they go then?
They are recognized in other comprehensive income, OCI.
OCI. So they appear in the statement of comprehensive income, but below the profit for the year line. They bypass the main P&L.
Exactly. They are accumulated in a separate component of equity, often called something like FVOCI reserve or fair value reserve.
Why do this? What's the benefit of putting these gains and losses in OCI instead of P&L?
For FVOCI debt collect and sell model, it reflects the dual objective. The interest income calculated using EIR still goes to P&L, like amortized cost, but the volatility from fair value changes linked to potential sale is kept out of P&L until sale. For FVOCI equity, strategic holdings, the idea is that since these aren't held for trading, their potentially significant market fluctuations shouldn't distort the entity's core operating profit reported in the P&L each period. OCI acts as a buffer.
Okay, that makes sense. But this leads to probably the trickiest bit and a favorite exam topic, I believe. What happens when you actually sell an FVOCI asset, especially the equity ones? You mentioned something about recycling.
Yes, the derecognition rule for FVOCI equity is unique and absolutely critical to understand. It involves what's called no recycling.
No recycling. What does that mean?
It means that when you sell an equity instrument that you had elected to measure at FVOCI, the accumulated gains or losses that have been sitting in that OCI reserve over the years are not reclassified, recycled, from OCI into profit or loss as part of the gain or loss on disposal.
Not recycled to P&L. So the profit on sale recognized in P&L doesn't include those past OCI movements.
Correct. The gain or loss recognized in P&L upon disposal is simply the difference between the cash proceeds received and the original cost, including transaction costs. The amount sitting in the OCI reserve related to that specific investment.
What happens to it? It just disappears.
No, it doesn't disappear. Instead, that accumulated balance in OCI, whether a gain or a loss, is transferred directly within equity from the FVOCI reserve to retained earnings. This transfer happens via the statement of changes in equity, so OCI.
Ah, okay. So the gain or loss eventually lands in retained earnings, but it bypasses the P&L for the current or any past period entirely.
Precisely. The conceptual reason goes back to that strategic intent. If the investment wasn't part of core trading operations, its disposal gain-loss, reflecting potentially years of market movements, shouldn't distort the current year's operating performance shown in the P&L. The no recycling rule keeps the P&L cleaner from the perspective of ongoing operations.
That's a massive distinction from FVTPL, where everything hits P&L.
Yeah.
And what about FVOCI debt? Is it the same no recycling rule when you sell those?
No, and this is another key difference. For FVOCI debt instruments, when they are sold, the accumulated gains or losses sitting in OCI are recycled to profit or loss.
Ah, so for FVOCI debt, the gain or loss on disposal recognized in P&L will include those previously recognized OCI amounts.
Yes. The logic here is different. Since the business model involved potential sale, collect and sell, recycling the OCI amount to P&L upon sale ensures the total return over the holding period, interest earned plus gain loss on sale, is ultimately reflected in P&L.
Wow. Okay. That equity versus debt distinction within FVOCI on derecognition is huge. No recycling for equity, recycling for debt.
Absolutely critical for exams.
Let's quickly use the Norman Strategic Shares example to cement the FVOCI equity treatment. He bought shares for $500, paid $48 costs, and elected FVOCI.
Right. So initial recognition is at fair value plus costs. $500,000 plus $40,000 plus $540,000 carrying amount. Transaction costs are included.
Okay. Then at year end, the fair value increases, creating an $80,000 gain. Where does that go?
Under FVOCI equity, that $80,000 gain goes straight to OCI. It appears in the statement of comprehensive income, but not in the P&L section. Equity increases by $80K via the FVOCI reserve.
Got it. Now fast forward. Norman sells these shares later for $650,000 cash. What happens now?
Okay, derecognition. First, remove the asset from the balance sheet. Carrying value $540K plus $80K gain equals $620K fair value just before sale. Let's assume value stayed same since year-end for simplicity, or use the year-end value. Second, recognize the cash received, $650,000.
So there's a gain on disposal based on cash versus value.
Wait, careful there. The gain recognized in P&L is technically just proceeds versus original cost basis, or similar concept, depending on the specifics. But the key point is the OCI treatment. That $80,000 that was sitting in the FVOCI reserve.
The accumulated gain from before.
It does not get recycled to P&L. Instead, you make a transfer within equity. You debit the FVOCI reserve by $80,000 to clear it out for this investment, and credit retained earnings by $80,000. This happens in the statement of changes in equity, OCI.
So the P&L for the year of sale doesn't show that $80 gain realized.
Correct. The P&L is protected from that accumulated gain. It ends up in retained earnings directly. That's the no recycling rule in action.
Crystal clear. That distinction is vital.
And just to round off derecognition more generally, the process of taking an asset off the books, the basic rule is pretty simple.
When does it happen?
Financial assets are derecognized when the entity either sells them, transfers substantially all the risks and rewards of ownership, or when the contractual rights to receive the cash flows from the asset simply expire, like a loan being fully repaid.
Okay. And the gain or loss on disposal? Proceeds minus carrying amount.
Exactly. Measured as the difference between the net proceeds received and the assets carrying amount at the time of disposal. And that gain or loss usually goes straight through P&L.
Usually. Except for that big exception we just covered.
Exactly. Subject only to that crucial exception for equity instruments measured at FVOCI, where the accumulated OCI is transferred to retained earnings instead of being recycled to P&L. For everything else, FVTPL assets, amortized cost assets, FVOCI debt assets, the gain or loss on disposal hits the P&L.
Got it. Now, before we completely leave assets, let's just touch on a practical point that sometimes confuses students in exams. The difference in treatment between, say, simple trade receivables and more formal loans or debentures.
That's a good point. While technically IFRS 9 applies to almost all financial assets, including trade receivables.
You probably wouldn't go through the full business model and SPPI testing for every single short-term invoice, would you?
Generally, no. For short-term trade receivables that arise from normal sales transactions and don't include a significant financing component, meaning payment is due fairly quickly, like 30 or 60 days, there are practical expedients. Often, they are initially measured simply at their transaction price.
So a simpler approach for routine stuff.
Yes. However, if an entity holds more significant, perhaps longer-term receivables or formal loans it has granted, or investments in debentures, basically anything that looks more like lending or investing.
Then the full IFRS 9 classification tests are mandatory.
Absolutely. You must apply the business model test and the SPPI test to those types of debt instruments to determine if they should be amortized cost, FVOCI debt, or FVTPL. You can't just default to a simple method.
That distinction is helpful. Okay, one final but massive topic related to assets before we move to liabilities. Impairment. Specifically, the expected credit loss model. IFRS 9 really changed the game here, didn't it?
It really did. This was one of the biggest shifts from the old IAS 39 standard. Impairment is about accounting for the risk that you won't receive the cash flows you're contractually owed.
And IAS 39 used an incurred loss model.
Yes. Under IAS 39, you generally only recognized an impairment loss after a specific loss event had actually happened, like a borrower missing a payment, entering financial difficulties, or going bankrupt. It was reactive.
So you waited for bad news before booking a loss.
Pretty much. Which, especially during the financial crisis, was criticized for being too little, too late. Provisions were recognized only after the damage was largely done.
So how does IFRS 9 change this with the expected credit loss, or ECL model?
IFRS 9 flips it entirely. It demands a proactive, forward-looking approach. The expected credit loss model requires entities to estimate and recognize potential future credit losses now based on past experience, current conditions, and reasonable, supportable forecasts about the future.
So you have to anticipate losses even before they happen.
Exactly. You recognize an allowance for impairment, reflecting the risk of default right from the moment you acquire the financial asset, even if it is currently performing perfectly well. This applies to assets measured at amortized cost and also to debt instruments measured at FVOCI.
Why is this shift considered so important for users of financial statements?
It provides a much more timely and realistic picture of credit risk. Think about banks again. Under IFRS 9, they can't wait for loans to go bad before providing for losses. They have to constantly assess the expected future losses across their entire loan book. This generally leads to larger, earlier recognition of impairment provisions compared to IAS 39.
Giving investors a better warning signal about the quality of the assets.
Precisely. It makes the balance sheet arguably more prudent regarding credit risk exposures.
Now, the actual mechanics of calculating ECL can get quite complex, involving different stages, right?
They can. IFRS 9 outlines a general approach, often referred to as the three-stage model, although we probably don't need to go into exhaustive detail for FR level, but the concept is important.
Can you give us the high-level overview of the stages?
Sure. Very broadly. Stage 1. This applies when the financial asset is first recognized, and as long as its credit risk hasn't increased significantly since then. In Stage 1, you recognize 12-month expected credit losses. That's the potential loss from default events occurring within the next 12 months. Stage 2. If the credit risk has increased significantly since initial recognition, but the asset isn't actually credit impaired yet, the asset moves to Stage 2. Here, you have to recognize lifetime expected credit losses. That's the potential loss from default events over the entire remaining life of the instrument. Stage 3. This is when the financial asset is considered credit impaired. There's objective evidence of impairment, like a default. You still recognize lifetime expected credit losses, but there's also a change in how interest income is calculated. It's usually based on the net carrying amount, after deducting the impairment allowance.
Well, okay, so the key takeaway is this move from 12-month ECL to lifetime ECL if the risk significantly increases, and that this assessment needs to be forward-looking.
Exactly. It's a continuous assessment incorporating forecasts. You can't just look backwards. It's a fundamental conceptual shift toward earlier recognition of potential credit problems. While the detailed calculations might be for more advanced levels, understanding that shift and the difference between 12-month and lifetime ECL is crucial for FR.
Perfect. That covers the asset side comprehensively: classification, measurement, derecognition, and the ECL concept. Now, let's flip the perspective. We've talked about the entity holding the asset. What about the entity that issued the instrument and has the obligation? Let's look at financial liabilities.
Right, the other side of the contract. Thankfully, the accounting for financial liabilities under IFRS 9 is generally less complex than for assets.
Why is that?
Mainly because that complex dual classification test, the business model and SPPI test, was designed specifically for assets. It doesn't apply to liabilities. The default treatment for most financial liabilities is much simpler.
So what is the general rule for measuring liability?
The vast majority of financial liabilities are measured at amortized cost. There is an option to designate liabilities at fair value through profit or loss, FVTPL, but it's much less common and usually only applies in specific circumstances, perhaps to avoid an accounting mismatch. So amortized cost is the main focus.
Okay, amortized cost again. Let's talk measurement. Initial recognition first. How does that work for a liability?
It's essentially the mirror image of an amortized cost asset, but with a twist for transaction costs. Liabilities are initially recognized at their fair value.
Which is usually the amount of cash received.
Typically, yes. The proceeds received when the liability was issued. But here's the twist. You recognize this fair value less any directly attributable transaction costs incurred by the issuer.
Ah, so if the company issuing the debt pays fees to arrange it, those fees reduce the initial liability recorded.
Exactly. Think about it. The issuer receives cash but immediately pays out some of that cash for issue costs, like legal fees, underwriting fees. The net amount they actually get to keep is lower. So the initial liability recognized reflects these net proceeds.
Okay, so fair value less transaction costs for initial recognition of liabilities at amortized cost.
Yeah.
That's another key difference from assets where costs were added.
Correct. A common mistake is to get that the wrong way around.
Got it. Now, subsequent measurement. You said it's usually amortized cost. Does that mean we use the effective interest rate, EIR method again?
Yes, absolutely. Just like with assets measured at amortized cost, you apply the effective interest method to liabilities. The mechanics are the same, but the perspective is reversed.
Reversed how?
Instead of calculating interest income, the issuer calculates an interest expense. This expense is recognized in profit or loss each period.
And is it also calculated using the EIR on the liabilities carrying amount?
Precisely. You take the carrying amount of the liability at the start of the period, multiply it by the EIR, which was calculated at inception to discount future payments back to the initial net proceeds, and that gives you the interest expense for the P&L.
Let's use the Norma example from the source material again, but this time from her perspective as the issuer of the debentures. This should show the amortized cost working for a liability.
Okay. Norma issues 20,000 debentures. They have a par value of $100 each, so she receives $2 million in cash initially, $20,100.
But she had issue costs, didn't she?
Yes, she incurred $100,000 in issue costs.
So following the rule, the initial liability recognized isn't the full $2 million.
Correct. Initial recognition is fair value to emitters less transaction costs, 100 kobo a day. So the liability starts on her balance sheet at $1.9 million. These are the net proceeds.
Okay, liability starts at $1.09 meters. The debentures have a coupon rate of 2% and redeem in 4 years at a 5% premium. The effective rate, EIR, is given as 4.58%.
Right. Now, subsequent accounting at the end of year one, Norma needs to calculate the interest expense.
Using the EIR. So $1.9 million times 4.58%.
Exactly, which is approximately $87,020. That's the finance costs hitting her P&L for year one.
But again, the cash she actually pays out is based on the coupon rate, right? 2% of the par value?
Yes. The cash interest payment she makes is only 2% of the $2 million par value, which is $40,000.
Okay, hold on. She recognized an expense of $87,020 in her P&L, but only paid $40,000 in cash. There's a difference again, this time $47,020. Where does that go?
Good question. For an asset, the difference increased the carrying amount. For a liability, it works similarly, but in the same direction, it increases the liability.
Increases the liability. Why?
Because the P&L expense, $87,020, reflects the true economic cost of the borrowing for that period. Since only $40,000 was paid in cash, the remaining $47,020 represents costs that has been incurred economically but not yet settled in cash. This amount is added to the carrying value of the liability.
So the liability carrying value at the end of year one goes up from $1.9 million to $1,947,020.
Precisely. 1.9 meters plus $87,000 cash payment.
And just like with the asset example, this systematic increase continues over the 4 years.
Yes. Each year, the interest expense is calculated on the opening liability balance using the 4.58% EIR. The difference between this expense and the $40,000 cash coupon paid gets added back to the liability.
Why does the liability need to grow? Oh, because it started below the redemption value due to the issue cost, and it needs to end up at the redemption value.
Exactly. It started at $1.9 million net proceeds, but it needs to be repaid in 4 years at a premium. The redemption amount is $2 million par plus a 5% premium, which is $2.1 million total.
Ah, so the amortized cost method, by adding that difference each year, systematically builds the liability up from $1.09 meters to exactly $2.01 meters over the 4 years.
That's precisely what it does. It ensures the total finance cost, including the effective issue costs and the redemption premium, is spread correctly over the life of the liability via the P&L interest expense, and the balance sheet liability accurately reflects the amount owed, growing towards the final redemption value. It's that financial clock mechanism again.
That makes the amortized cost for liabilities much clearer. It's the same engine, just running from the borrower's perspective.
Yeah.
Okay, now for something that seems significantly more complex on the liability side, instruments that have both debt and equity features. We're talking convertible debentures or convertible bonds.
Yes, convertibles. These are a classic exam area because they perfectly illustrate a fundamental accounting principle: substance over form.
Substance over form, meaning you account for the economic reality, not just the legal form.
Exactly. When a company issues a convertible debenture, legally it might look like just one instrument. But economically, in substance, the company has done two things.
What are the two things?
Firstly, they've created a financial liability, a contractual obligation to make cash payments, interest and principal, in the future if the holder doesn't convert. Secondly, they've granted the holder an equity option, the right to convert the debt into a fixed number of the company's ordinary shares instead of receiving cash repayment.
So it's part debt, part potential equity.
Correct. It contains both a liability component, the promise to pay cash, and an equity component, the value of the conversion option itself. And because these two components have different characteristics, one is a liability, one is equity, IFRS requires the issuer to use split accounting right from the start.
Split accounting, meaning you have to separate the instrument into its liability part and its equity part on the balance sheet at inception.
Yes, you must allocate the proceeds received from issuing the convertible instrument between these two components when it's first recognized. And this split is done at inception and isn't changed later.
Okay, how on earth do you do that? How do you figure out how much of the cash received relates to the debt part and how much to the equity option? Is there a specific valuation process?
Yes, there's a strictly defined process, often called the residual method. And the key is you must calculate the value of the liability component first.
Calculate the liability first.
You figure out what the future cash flows would be if the instrument were just a normal, non-convertible bond. That means you take the stream of required cash payments, the regular coupon interest payments, and the final principal repayment, assuming it's not converted, usually redemption at par.
Okay, map out the cash flows of the debt part. Then what?
Then you discount those future cash flows back to their present value.
Using what discount rate? This feels critical.
It is absolutely critical. You must use the prevailing market interest rate for similar debt issued by that company that does not have the conversion option.
Whoa, okay. So you need to find the interest rate the company would have paid if they'd issued plain vanilla, non-convertible debt at the same time.
Exactly. Why? Because that market rate reflects the pure cost of borrowing for that company without any sweetener effect from the conversion feature. Using this rate isolates the present value of the pure debt component, effectively stripping out the value attributable to the equity option.
Right. Let's use the Alice example from the sources to illustrate. She issued $100 million of 4% convertible debentures.
Okay. Total proceeds, $100 million. Coupon rate, 4%. Now, the crucial piece of information is the market interest rate at the time for similar debt issued by Alice but without the conversion feature. The source tells us this rate was 6%.
So 6% is the rate we use for discounting, not the 4% coupon.
Correct. We take the future cash flows, the 4% annual coupon payments, $4 meters per year, and the final $100 million principal repayment, and we discount all of those back to present value using that 6% market rate for non-convertible debt.
And the result of that discounting calculation gives us?
According to the source example, the present value of those cash flows discounted at 6% comes out to be $94.7 million.
So $94.7 million is the value allocated to the financial liability component.
Precisely. That's the amount recognized initially as a non-current liability on Alice's balance sheet.
Okay, but she received $100 million in total cash.
Yeah.
If 94.7 meters is the liability, what about the remaining $5.3 million?
That remaining amount, The difference between the total proceeds, $100, sirs, and the calculated value of the liability component, $94, 7 and pinners, is the residual. And this residual amount, $5.3 million, is allocated to the equity component.
So the equity value is just whatever's left over after valuing the debt part. You don't try to value the option directly.
Correct, and that's a major exam trap. Students might be tempted to try and value the conversion option itself, perhaps using option pricing models, but IFRS mandates the residual method for the issuer. Liability first, equity is the plug figure. It's simpler and more reliable.
Okay, liability, $94.07. Equity, $5.03 at inception. What happens subsequently?
Yeah.
Does the equity amount change?
No. The crucial point here is that the equity component, $5.03, is recognized directly within equity, often in a conversion option reserve or similar, and it is never subsequently remeasured or amortized. It just sits there in equity unchanged.
Unchanged. Until what?
Until the debentures are either actually converted into shares, or they mature and are redeemed for cash, or they are repurchased early. Only then is that equity reserve dealt with.
Okay, so the equity part is static. What about the liability part, the $94.7 million?
The liability component behaves like any other liability measured at amortized cost.
Meaning we use the effective interest method again.
Yes. We need to unwind the initial discount. Remember, we recorded the liability at $94.07, but it represents an obligation to eventually repay $100 meters, if not converted.
So we need to build the liability up towards $100 over its life.
Exactly. And we do this using the effective interest rate that we used for the initial discounting, that 6% market rate for similar non-convertible debt.
So each year, Alice will recognize an interest expense in her P&L calculated as 6% of the liability's opening carrying amount.
Correct. She'll compare that 6% expense to the actual 4% cash coupon paid, and the difference will be added to the liability's carrying amount, gradually increasing it from $94.77 and towards the $100 redemption value.
So even though the equity part is static, the liability part is dynamic, growing over time through the amortized cost mechanism, generating an interest expense in the P&L based on the 6% market rate.
You've got it. That split accounting and the subsequent treatment are fundamental for convertible instruments issued by a company.
Okay, we've really drilled down into the mechanics of classifying and measuring assets and liabilities, including the complex ones like convertibles. But we should always circle back to why we're doing all this. Why do the users of financial statements, investors, lenders, analysts, need all this detail?
That's where the related standard, IFRS 7, financial instruments, disclosures, comes into play. All the complex measurement rules in IFRS 9 are only useful if users also get enough context and explanation.
So IFRS 7 provides that context.
Yes. IFRS 7 is crucial because financial instruments, especially things like derivatives or complex debt, can sometimes involve very little initial investment, but expose the company to potentially huge future gains or losses. They can be opaque. IFRS 7 aims to force transparency around them.
What are the main objectives of the disclosures required by IFRS 7? What should users be able to understand from them?
IFRS 7 aims to ensure users can evaluate two primary things. Firstly, the significance of financial instruments to the company's financial position and performance.
Meaning how much they matter, what kinds they have, how they're classified, what their carrying values are.
Exactly. Providing that basic quantitative map of the financial instruments on the balance sheet and their impact on P&L and OCI. But secondly, and arguably even more crucial, IFRS 7 requires disclosure so users can evaluate the nature and extent of risks arising from those financial instruments and how the entity manages those risks.
Wow, so it goes beyond just the numbers on the face of the statements and gets into the actual risks the company is facing because of these instruments.
Precisely. It requires quite extensive disclosure, often both qualitative, describing risk management policies, and quantitative, providing sensitivity analyses or maturity breakdowns.
What are the main categories of financial risk that IFRS 7 focuses on? What do companies need to talk about?
Generally, we focus on three main buckets of risk. And understanding these is vital because IFRS 7 often requires specific disclosures about the company's objectives, policies, and measurement techniques for managing each one.
Okay, what's the first one?
Number one is credit risk.
The risk of someone not paying you back.
Essentially, yes. It's the risk that one party to a financial instrument, like a borrower or a customer, will cause a financial loss for the other party, the lender or seller, by failing to meet their obligation.
So this is most relevant for financial assets like loans and receivables,
Hmm.
the ones we apply the ECL model to.
Exactly. If an entity holds significant amounts of trade receivables, loans, or debt securities measured at amortized cost or FVOCI debt, their exposure to credit risk is a major concern for users.
What kind of disclosures would IFRS 7 require about credit risk?
Things like the maximum exposure to credit risk, usually the carrying amount of the assets, a description of any collateral held, or other credit enhancements. And importantly, an analysis of the credit quality of the assets. Are they high grade, medium grade, past due? Often this is broken down by counterparty type or geographical region. It helps users assess the likelihood of those ECLs actually crystallizing.
Okay, credit risk. What's the second major risk category?
Second is liquidity risk.
Liquidity, the risk of running out of cash to pay your bills.
Pretty much. It's the risk that the entity will encounter difficulty in meeting its obligations associated with its financial liabilities as they fall due. Can the company find the cash needed to pay its debts on time?
This sounds crucial for assessing short-term solvency.
Absolutely. Disclosure about liquidity risk is vital for creditors and short-term lenders. The most common and important disclosure here is a maturity analysis.
A maturity analysis.
Yes. It's a table showing the remaining contractual maturities for all financial liabilities. It breaks them down into time bands, for example. Amounts due within 3 months, 12 months, 1 to 5 years, over 5 years. This allows users to see the timing and scale of upcoming cash outflows required to settle debts.
Very useful.
Okay.
Credit risk, liquidity risk, what's the third main category?
The third is market risk.
Market risk. This sounds broader.
It is. Market risk is the risk that the fair value or the future cash flows of a financial instrument will fluctuate because of changes in market prices.
What kind of market prices?
It encompasses several subtypes. The main ones are interest rate risk. The risk that changes in market interest rates will affect an instrument's fair value, especially for fixed-rate debt, or its future cash flows for variable rate debt. Foreign currency risk, or FX risk. The risk that fluctuations in exchange rates will impact the value of instruments denominated in foreign currencies. Other price risk. This catches fluctuations due to other market factors like changes in equity prices for share investments or commodity prices if instruments are linked to them.
So market risk covers interest rates, FX rates, share prices. How do companies disclose their exposure here? It seems hard to quantify.
It can be. A common requirement under IFRS 7 for market risk is sensitivity analysis.
Sensitivity analysis.
Yes. The company has to show what impact a reasonably possible change in the relevant market risk variable would have on its profit or loss and its equity. For example, they might disclose, if interest rates had been 1% higher, P&L would have been X lower and OCI would have been Y lower. Or if the euro exchange rate had strengthened by 10%, P&L would have been Z higher.
Ah, okay. It gives users a feel for how vulnerable the company's results are to these market movements.
Exactly. And this is where you really see the impact of the measurement categories. Instruments measured at FVTPL expose the P&L directly to market risk, so the sensitivity analysis for those will show a direct P&L impact. Instruments at FVOCI expose OCI. Amortized cost instruments are less directly affected by market price changes in the accounts, though interest rate changes do affect their EIR calculations over time.
So putting IFRS 9 measurement and IFRS 7 disclosure together gives you that full picture, how instruments are accounted for and what risks they bring.
That's the goal. IFRS 9 forces measurement based on the underlying economics, the business model, and the cash flow characteristics. IFRS 7 then forces the entity to explain the resulting risks and how they're managed. It aims for a comprehensive understanding for stakeholders.
It really ties it all together. It makes you appreciate that while IFRS 9 aimed for simplification compared to IAS 39.
It's still a very demanding standard.
Definitely. But mastering that initial classification logic, those dual tests, the business model and STPI really seems like the absolute critical starting point.
It truly is. If you understand the why behind the classification, why is this simple loan at amortized cost? Why is this complex derivative at FVTPL? Why is this strategic shareholding at FVOCI? Then you can usually work out the subsequent accounting treatment that follows. That logic is the key. Hashtag tag outro.
Well, that brings us towards the end of this particular deep dive into IFRS 9 financial instruments. We've covered a lot of ground.
We certainly have.
We navigated the classification landscape for assets, really focusing on the mechanics and logic of that two-part test, the business model test and the SPPI test.
Yep, the gateway to measurement.
And we detailed the initial and subsequent measurement rules for all three main categories. Amortized cost, with its EIR calculations.
Fair value through profit or loss with its immediate P&L impact.
And fair value through other comprehensive income, including that really vital no recycling rule for strategic equity investments versus the recycling for FVOCI debt.
Key distinctions there.
We also looked at the flip side, financial liabilities, mostly amortized cost, remembering to deduct issue costs initially, and using the EIR for expense.
And we tackled those complex convertible instruments, emphasizing the substance over form principle and that split accounting using the residual method liability first.
Liability first, equity residual. Got it. And we briefly touched on the conceptual shift to the forward-looking expected credit loss model for impairment and the importance of IFRS 7 disclosures for understanding risk.
So a fairly comprehensive tour.
Definitely. Any final thought or piece of advice for listeners trying to get to grips with IFRS 9 for their exams?
I think it comes back to what we said about logic. Before you even pick up your calculator in an exam question involving IFRS 9, take a moment. Ask yourself those two fundamental questions about the asset. One, what is the company trying to achieve with this asset, the business model? And two, what are the cash flows designed to be, SPPI?
Business model and cash flow characteristics.
Get those right, and the classification follows.
Yeah.
The classification dictates the measurement category, and the category dictates the accounting rules. Master those initial filters, understand the why, and honestly, IFRS 9 becomes much more manageable, less about memorizing rules and more about applying principles.
Great advice. Focus on the logic.
Right.
Okay, this deep dive, as always, is part of the SmartPass series, which we've designed specifically to help you build understanding and pass your ACCA FR exam with confidence.
Hopefully it's been useful.
Absolutely. And for more help, do check out the video description. You'll find links there to other SmartPass study resources. And of course, please hit that subscribe button on the SmartPass YouTube channel. We've got more expert-led structured guidance coming up covering other key IFRS and financial reporting topics.
We'll be covering more soon.
Excellent. Well, until next time, keep diving deep into those numbers and keep focusing on the logic.
Good luck with your studies.